Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another training, another review of Velocity Banking with an emphasis on landlording. Now, if you ask the average person, are landlords rich? Most of them will say yes, because they're paying their biggest expense to the landlord. But did you know that the landlord's biggest expense goes to the bank, right? So let me just start off with this. I'm going to ask ChatGPT, why does it feel like as a landlord, I am unofficial middle management for the bank, right? And let's see if ChatGPT says, "Am I crazy?" or if the AI bot can empathize with me. Okay, so let's go ahead and do that. Ooh, I like this answer. Okay, this looks really good. So once it's done, I'm gonna go ahead and click the play the voice button. So give me one moment.
It can feel like you're unofficial middle management for the bank, because, as a landlord, you're the one dealing with all the day-to-day responsibilities and risks, while the bank earns steady returns on its loan to you. Here's why it might feel this way. 1. Financial leverage. You take on the debt and make the mortgage payments to the bank, but the bank doesn't share the risks of tenant issues, property maintenance, or market fluctuations. They get paid no matter what, and you're managing the operational side, which feels like you're doing the hard work while they collect the profits. 2. Responsibility for property management. You handle the property management, repairs, and tenant relations, essentially acting as a middleman between the tenants and the bank's investment. The bank doesn't get involved in these tasks, but expects its loan payments regardless of what's happening with the property. 3. Profit distribution. Even though you are the property owner, a large portion of your rental income may go toward the mortgage, interest, insurance, and taxes, leaving you with a slimmer profit margin compared to the bank's relatively low-risk return on their loan. 4. Interest payments. In the early years of a mortgage, the bulk of your payments go toward interest, not principal. So it can feel like you're working to ensure the bank makes money before you really start to see significant gains from paying off the property. 5. Pressure from market conditions. If the real estate market or rental market isn't favorable, you're left to deal with vacancies, repairs, and difficult tenants, while the bank's interest in the loan remains unchanged. Does that align with your experience, or are there other frustrations that contribute to this feeling for you?
Ooh, that's a pretty good explanation, right? And I don't know if you feel this way, but when I read this, I feel tired. I feel like that energy of a tired landlord. And you might be thinking, tired landlord? Do they exist? Yes. Because if we just been tired landlords in Google, right, there's a whole bunch of articles about how you can reach out to these people because these people are a good source of real estate deals. I mean, think about it, right? You're doing all the work, the bank's just sitting there doing nothing, and they're making all the money. Okay, and we have to learn how to reverse that situation. Now, I don't know if you knew this or not, but if I go to biggerpockets.com, which is the biggest real estate investing website, and look up what good cash flow is, on their website, they got an article about this, right? What is average or good 2023? Okay, and so if I scroll down here and keep scrolling down, it's somewhere. And look how this is in quotes, right? And I always love mentioning this article because who would have known that for a single family rental home, that $100 to $200 in monthly cash flow is considered to be good. Like again, you got to do all this work, and how much is the bank making? The bank is making bank, right? The bank is making bank. I think there's a reason making bank means what it does. Okay, so what we're gonna do is we're going to reverse the situation as a velocity banking landlord. Now, I'm not saying you have to do what I do. I'm just showing you what I do, right? Maybe you have a better strategy than I do. I don't care, but I'm just showing you what most landlords go through, why they would be tired because they're just unofficial middle management for the banks and they're not entrepreneurs and business owners and they don't feel like landlords, okay? So let's go ahead and get started with Velocity Banking. And there we go. Give me one moment. Yep. So what is Velocity Banking? All it is a debt payoff strategy using a line of credit as your main operating account. So in order to do velocity banking, we need two things: a budget and then a line of credit. Okay. So before we get started, I just want to point this out. So let's say I'm making $6,000 a month, and with all my expenses, I decided, hey, I'm actually going to buy my own rental property for the first time. Okay. But here's the thing: if your tenant doesn't pay you, and you're in a position that you're actually going to be screwed because of that, you want to go into landlording in a position of strength. So I personally would not ever get into a rental property if I actually needed the tenant's income. It's the same philosophy that I have when I deal with banks. Like I always want to go into a bank when I don't need their money. Okay? Same thing with the rental property. Hey, I only want the tenant's income if I actually don't need it because it's there to help me grow my wealth, right? Too many people, especially during early 2020, were at the mercy of their tenants. And if they didn't, if the tenant didn't pay, it's like, oh my goodness, I can't believe my tenant didn't pay. We signed a contract. And again, I'm not giving legal advice, but I'm saying that just because someone signs a contract doesn't mean they're going to always, they're obliged to go through with it, other than when you take them to court. You know what I'm saying? So, what I would do, and this is just me, I'm not giving you advice, is I would put this on hold. I wouldn't invest in a rental property until I got my a personal finances order. So let's say this is zero, okay? This is zero. So right now, with all of our budget, we noticed that we have $6,000 of income. We're not going to invest into rental property yet, right? We got three credit cards, an auto loan, and a personal mortgage. And I would say, just me personally, I might actually start investing in real estate when all my debts, except for my personal mortgage, is paid off. Okay, so let's go ahead and do that. And so what we're going to do is we're going to assume that we have the same income and we have no savings at all, because that's what velocity banking is. It's a strategy where you completely put every single dollar that you have into debt. Okay, every single dollar. And the reason that most people can't do that is because they freak out. It's like, oh my goodness, so I put this into a loan, where do I get my money back, right? If I have an extra $1,100 in my savings, I don't want to put that all into a loan. And what happens, unfortunately, is that we experience something called the segregation of income effect. So what velocity banking is you're putting all of your money into one place. This whole $6,000 goes into debt, which will be our line of credit. Now, what is the opposite of velocity banking? It's actually segregating our income. So what do I mean by that? And let me just show you an example here. This is a real life case scenario that I went over in a live stream, right? So someone made $5,474 of income and $5,470 of expenses with $4.10 left over. And look at this, 22 debts. 22 debts. And I went over this in a live stream, but this is only for YouTube channel members, 99 cents a month. So if you want to take a look at that, you got to join the YouTube channel. But what I'm saying is that because your income comes into your checking account and it's split 22 different ways, it's not going to be as effective if it's just in one place. Okay? So we're not going to segregate our income. It's the same thing as a landlord. The reason why so many landlords are broke, okay, is because they're segregating their income, and which we're not going to do, right? So now let's go ahead and do this. Well, we're going to select the line of credit as our main operating account. And again, I got tons and tons of lines of credit, right? So what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and then use it over and over again. And let's just kind of do this. Let's assume that we have a $50,000 line available. Now, in real life, would we have a $50,000 line available? I don't know, right? Sometimes maybe you got it before you need it, but the secret to getting credit is always get it before you need it, right? Some people, they become broke, but they were broke at a point right at, like, way after they got the line of credit because they didn't know how to use it properly. So they got lucky on that one. But I'm going to tell you the secret to lending is that banks don't lend money to people who need it. So the whole point of this is not to say, hey, a bank is going to save you with the line of credit. No, the whole point of this is never actually get to segregating our income and just paying minimum payments on everything, right? Get the tool before we ever need it. Okay, hopefully that makes sense. So let's go ahead and get all of these. So how much is this? That's 17 plus 18 plus 10K. So that's 45K. Let's move this $45,000 balance into that line of credit. And so just by simply moving these credit cards, okay, guess what happens to the payments? This is 000, right? And now this is $1,100 in savings to $2,600 in cash flow, okay? And what we're going to do is put this entire paycheck into that line of credit and then expenses out of the line of credit, right? Out of the line of credit. And then our cash flow, our monthly cash flow is going to be used to pay all of this down. And so once we've gotten rid of our credit cards, our auto loan, okay, our auto loan, then we're in a much more better, or how, I don't know the best way to say it, we're in a stronger position. We're in a position of strength when we get to landlording. So if a tenant decides, hey, I'm not going to pay, blah, 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 okay, easy to kick them out, right? Where it's much harder to kick out somebody when you depend on their money, right? This is one of the most important lessons that you're going to learn about being rich is that you need a wide net of let's say income sources, customers. Just don't depend on one person for your livelihood. That's a really important thing. I mean, think about the government, right? Where's the tax money come from? Just one person? No, it comes from a whole nation, right? So that's where they get all this oodles and oodles of money from. So as a landlord, okay, if we're at the mercy of our tenants, we're screwed, right? We should never be in that position, which is why we're focused on paying off our personal debts first, okay? Because tenants are not always innocent, although they vote, right? So one of the other things I kind of want to mention, right, is that I got oodles and oodles lines of credit too. Right, I tell you this: $280,000 line of credit, 15,000. I got over $500,000 in lines of credit. So when someone like writes a comment like, "I don't know how to get a line of credit," bro, I gave you the plan. The plan is to get it before you need it, right? It's a mentality that you can walk into a bank, fill out an application, and feel confident that they're going to give it to you because 90% of it is mental, right? 10% of it is rational. But most of you can't even apply because you're afraid to apply for it because you're afraid of rejection. Whereas, hey, I get rejected all the time. I actually applied for a credit limit increase with a major bank today. You know what? I got rejected. I got rejected 12 times this year. But you know what? I know the saying is cliche, but you miss 100% of shots you don't make. Now you got to be a little bit strategic about it, of course. But I have a $527,000 in lines of credit because a lot of it is just mental, and you understand the game plan of getting it before you need it, right? So let's go ahead and do this and do the actual velocity banking strategy. Paycheck in. So when you put your entire $6,000 into that line of credit, that minimum monthly payment doesn't matter. Not only that, it minimizes the average daily balance, which also reduces the interest. So let's go ahead and do this. I2 plus 1. And then the next month's balance plus the next month's interest. Or I'm sorry, the next month's balance is based on the previous month's balance plus the previous month's interest plus our cash flow. So that's 2689.31. And then what you do, okay, what you do is you take the average daily balance, right? And you get that. And again, the interest is not going to be 43 grand. Or it's never going to be 43. That's insane, right? Like that's not going to happen. So you multiply it by the interest rate, 0.08, okay? And so that's 3 grand, which is kind of a lot, right? 3 grand. No, it's actually 8% divided by 12 because the interest is quoted annually, okay? It's quoted annually, but it's calculated monthly. Okay, so let's go ahead and do that. And you can see that the interest is actually really manageable. $291, not bad for being 45 grand in credit card debt. Okay, so now let's go ahead and do this and copy and paste. And now we see that in about 18 months, so I think 1.5 years, if that seems right, we're going to be debt free, completely debt free. So actually, let me put maybe another color. Uh-oh, did I screw up? Whatever. Okay, never mind. Whatever. All right, so now 18 months, and we're in 45K of debt that's eliminated. Okay, so 45K. And I should put the number of months first. So 18 months, and then 45K of debt eliminated. And then I'm going to copy and paste, right? And now what we got to do is focus on these other two loans that we have, the auto and the personal mortgage. Now, here's the thing. I'm going to focus on the auto, right? Definitely because it's a lower payment, or I'm sorry, lower balance, higher interest rate, And not only that, it sucks up more cash flow. Okay. So interest rate is related to cash flow, but there are three main factors: length of the loan term, the interest rate, and the original balance, right? So think about this. If I pay this 22 grand off, I get $400 of cash flow back. If I pay $210,000, which is like 10 times more, I only get double the cash flow, right? So we want to focus on paying off the auto loan first, okay? So I have this loan calculator right here, and actually let's ignore this part. So what we do is we write in the loan calculator how many months have passed, and you see right here is 18. So let me just put 18, 18, okay, 18, 18. And then we can see right here what the current balance is, how much interest we paid, and the thing that I'm not going to explain too much in this video, which is the cash flow index, which is basically a ranking system of how you would pay off these loans, right? The lower the number, the better. Lower than 50, better. That's like a quick summary. So if it's lower than 50, let's go ahead and pay this one off. So 16 grand. So what we're going to do is pay off this 16 grand into this line right here. So let's go ahead and copy that. And then I'm going to add 16076.43, right? And oh, that looks better with the green font. That looks beautiful. Okay, so now we got that covered. And then guess what? By moving that auto loan, we get this $425 payment back. So this becomes zero. Okay, this becomes zero. And take a look at this. Now our cash flow is over 3 grand. That was pretty easy. So in 18 months, 1.5 years, our cash flow just literally more than doubled. Okay, so let's go ahead and do this. And we're going to copy this cash flow. So now instead of 2689, it's 3114.63. Okay. And then now let's go ahead and copy and paste. And then we see that in 23 months, about 23, so about 2 years, we're completely debt free except for the mortgage. Okay. So now it's going to be 23 months, and then it's going to be 67K. All right. So now, okay, now maybe it might be time to get into an investment mortgage, right? Now might be the time. I mean, we don't have to do it. We can just focus on paying off our own personal mortgage. But we got oodles and oodles of cash flow through over 3,000. So if we have a tenant, and let's do this right here. Let me go ahead and copy and paste most of this stuff. So we'll just say investment mortgage, right? So this will be $200,000 at 8%, because I don't know if you know this or not, rental property mortgages are considered to be much higher risk for the banks, right? If something happens to your personal home, you'll fight to keep it. If something happens to your rental home, you're like, I'm not going to fight to keep it as much, right? Because you don't live there, okay? So just be aware of that. And so let me go ahead and do this, okay? So now you can see here the monthly payment is $1,467. And again, we want to think about, let's say, the worst case scenario. So if we go in here, 1467, even if we never get the tenant's income, okay, we're gonna have cash flow. We're gonna be okay. I think we'll be okay, right? So let's do this, okay? So let's first of all, here's rule number one. We need to buy real estate at a discount. We need to buy real estate at a discount. So we're not going to buy a $200,000 property for $200,000. We're going to get a $300,000 property for $200,000, right? And the easiest way to do that is find a distressed seller. So you take a look at this. This is my rental property right here. Again, Zillow says it's about 330. I bought it for 210, fixed it up. I got a tenant, right? And if you take a look right now, it's been less than 2 years since I've owned it. I have a huge amount of equity. I'm pretty much almost at like a 50. I think I'm already at a 50% equity position under 2 years, right? $165,000 in principal, 330 in the what's it called? The estimated retail the value of the home, estimated home value, the estimate. So I got a lot of equity in there, right? And so what I'm gonna do is I'm just gonna pay this sucker off. But again, much better when the home is bought at a discount. It's something we have to remember, right? And not only that, when we have the rental property, we gotta get good tenants. We gotta get tenants that appreciate us after giving us a 14 grand check, right? You see this? This is the unsolicited text from the tenant, my tenant, 14 grand and said, thank you so much for everything. We appreciate you, right? We want to do that. Okay. 14 grand. So, all right. So as you can see here, and actually, let me just quickly calculate how much equity I have for this property. 332,000 minus 165,192, right? Ooh, I got $166,000 of equity. That's pretty sweet. That's what they call a spicy meatball, right? Right. So back to my point. Always buy it at a discount, right? Always buy it at a discount. But even if you buy it at a discount, doesn't mean you might cash flow, right? Like if I get a $1 million San Francisco or $2 million San Francisco single family home, and I get it for $1 million, and the rent doesn't support that $1 million purchase price, even though it's $1 million discount, I don't know what to say, right? But what I'm saying is that buying at a discount doesn't necessarily solve your cash flow issues. But that's what you immediately want to do if you want to make sure that if something happens to you, you can immediately sell and you'll be fine. Okay? So let's do this. What we're going to do is we're going to combine our income and the tenant's income, and with the help of a line of credit, just pay off our loan quickly, right? Our line of credit is kind of like a bridge. The reason why we don't dump our money directly into into the loan itself is because what happens is that when we put all of our money, all this money with the tenant's money, it just becomes a mess. It's going to be segregated. I almost 99% guarantee you don't want to be in this situation. You just want to put your money into one place. So it'll make your life infinitely easier. Okay? All right. So now let's think about the traditional landlord. Remember how we got about the tired landlords, about the $200 of cash flow? Well, 200, okay, times 12 months times 30, right? That's 72,000. So a traditional landlord only makes 72K of cash flow for 30 years. Okay, so 30 years, right? So now, how much does the bank make after 30 years? Well, let's go to our loan calculator. All I got to do is type 360, which is 30 years, and take a look at this. Oh my goodness, $328,000 of interest. Whoa, no way. I think that's a Keanu phrase. No way, right? So now the bank, and actually, let me just do this. I'll just say you, the landlord, and then the bank is going to make 328K of interest. So listen, they're making about 5 times more than you, 4 to 5 times, like maybe 4.5, around 5 times more than you, right? So who's going to be the winner in this situation? Is it you or the bank? It's the bank because they do nothing, they make all the money, right? Whereas the Velocity Banking Landlord, we want to switch it up. Okay, we want to switch it up. So let's just do this. Okay, so let's assume that for our rental property, it's about $2,000 a month. Okay, we get $2,000 a month rent. And just because a property is $300,000 doesn't mean you're going to get $3,000 a month rent. You know, the rent is the rent and the purchase price is the purchase price, right? You got to know your market conditions. And so many people, when they go into real estate investing, they don't want to know that. They're just like, I just buy any old property and I'll be good. No, no, no. You got to know your market, right? That's a very important lesson, okay? So what we do is we're going to assume $2,000 of income a month, and we'll assume that we get 70% of it because 30% goes to expenses, okay? Now look at this, we had $3,000 of cash flow a month. Now let's just do this, okay? How long is it going to take to pay off? And let me go in here into the loan calculator. Um, $10,000 of the principal, like 190, right? 190. Let me just kind of type in a random number. Well, let's 12 times 5. Is it 60? Okay. Whoa, 60, right? So it's about like 5 years to pay off $10,000 of the loan, right? So why don't we just move this $10,000 of the loan into the line of credit and see how much it'll take to pay off with our cash flow, right? So let's just do this. We're going to add $10,000 here at 10000, right? And then now our cash flow is about 3047.1. Okay. Okay. And now, how long did it take to pay it off? Wait, 1, 2, 3 months? Are you kidding me? So basically, it took me 5 years to pay $10,000. Almost, it's not even 10,000, right? It's almost $10,000 of a loan, right? 5 times 12 is it 60? Let me just check one more time. I can't even believe this. 5 times 12. It is 60. So 5 years did not even shave $10,000 of the loan, and we pay 78 grand in interest, right? And you can see here, oh my goodness, we paid this off in 3 months. That was easy. And look how little interest we paid for using that line of credit to help us not segregate our income. Look how easy that was now. All right, so let me go ahead and open up the Velocity Banking Calculator so that we can clearly see how long it will take us to pay off this investment mortgage. Okay, give me one moment. All right, there we go, right? So here's the thing, right? So if we have a $200,000 loan, we could actually, it really doesn't matter like how much we chunk, because if the interest rate is the same, or meaning that if we have the same interest rate, moving a loan into a line of credit, like the amount that you put in doesn't really matter. It really doesn't, okay? But we just fill in all the deets, the details. But even if we replace this mortgage, we should be fine. The problem comes when you have a lower interest rate mortgage, like a non-investment mortgage, and move into a line of credit. But again, this is to prevent the segregation of income. This is make it to help us pay it off easier, right? Because why are landlords only getting $200 of cash flow? Because they're segregating their income, and they're not putting all of their money into the debt. So let's just do this. We'll say this goes to $10,000 of our loan into the line of credit. It takes about 5.1 years to pay it off, right? 5.1 years. All right. And so now what we're going to do is we'll have a paid off house. And here's the crazy thing. I actually didn't include the tenant's income. So if we're the worst landlord in the world, this is crazy. I didn't even include the tenant's income. If we're the last worst landlord in the world, it should take us about 5.1 years to pay it off. Now let's go ahead and include the tenant's income. Okay, so plus $2,000 multiplied by 70%, right? So 30% we could kind of estimate goes to expenses. Again, they depend on your market, right? Every market is different. Every market is local. Some rent markets you're not going to cash flow no matter what you do, like Hawaii, California, NorCal, San Francisco, probably New York City, right? It's all equity play. If you don't know what I mean, it's just forget it, okay? But what I'm saying is that we're just going to use 70% as a general expense figure, okay? So now let's take a look. What? 3.6 years? That's get out of here. Right? So take a look at this. In 3.6 years, the bank only made 30K. Now let's calculate how much money we make. So 30 minus 3.6, that's about 26.4 years. So to calculate our cash flow, all it is 26.4 multiplied by it's 2,000 times 0.7, 70% of the 2,000 times 12, okay? Because it's 12 months in a year. Should be it. We'll see. So we get $443,000 of cash flow. Again, for the first 3.6 years, we're not taking any of that cash flow. We're just using it to pay off our debt, right? And then once we paid off our debt for the next 26.4 years, we're getting $443,000 of cash flow. And look how much the bank made. Only 30 grand of interest in the first 3 years. Haha. So now let's go ahead and make our bank cry. No, I'm just kidding. We're not. Are we really going to do that? I don't know. All right, so give me one moment and let me write down these statistics or findings right here. So you will make, what is that? Let me just check one more time. 443K, not for the entire 30 years, because remember the first three we focus on paying off that debt, and the bank is only going to make ooh, 30K. So now who's the boss, right? Now you're not going to feel like middle management here. Your bank is just your vendor. It's just your, third party helping you get into the property. You're not the middle management, but as a traditional landlord, only making $200 of cash flow a month. Oh man, I do feel like a middle management where the bank makes all the profits and I'm doing all the hard work. No, we don't want that. We don't want that, right? But as a velocity banking landlord, holy, right? And let's just repeat the process over and over again, right? We get another property, $300,000 property at $200,000, right? Get out a discount, do some repairs, blah, 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 blah. Be in a situation here, and I'm going to pay this off probably in like 2.5 years. It's crazy, right? I paid off my own home first. Now I'm focused on this, and then I'll have like two paid off homes soon, I think. We'll see how it goes. But I did a live stream celebrating, hey, I paid off my mortgage under 3 years, right? All right, so get another $200,000 home and just rinse and repeat the process again. So let's go ahead and do that. So again, if we're here, right, let's go ahead and add the other tenant, the next tenant, right? We just add same process, same $200,000 loan, and then we'll blam, next property pays off in 2.8 years. Okay, so the first one was 3.6, right? So 3.6 was the first one, and then the next one is 2.8. Okay, and then after that, we just rinse and repeat again, right? We'll just rinse and repeat again, and we're going to go ahead and do that, and wablam, whoa, 2.3 years, 2.3, right? So we'll have three fully paid off houses, and let's go ahead and calculate this. So remember, each house that you paid off took less time than most people will ever pay off a car. All of them. 3.6 years in a house paid off is less time most people will pay off a car. Okay? So that's 8.7 years. So let's make it a 10-year plan, right? We'll just do this one more time, and we'll make it a 10-year plan. Okay? Let's do that. So the fourth house is 1.9 years. So let's add 1.9. Okay? Whoa, all right. So now we got four houses. Four houses. Okay? So let's think about this. So 10 years, four houses, okay? And we'll assume that because of appreciation, they're worth 350k each, right? Maybe they're not worth 300, they're worth 350k each. And then the cash flow of each property is about, we'll just kind of do cowboy math and estimate it to be about 443,000. 443,000. Okay. So 443. Okay. So what we're going to do is estimate the value, because the value of each house is going to be both in the equity and the cash flow, right? So again, we just combine these, multiply by 4, and then we could see that within 10 years we've acquired an extreme amount of wealth. Okay. Now the cash flow you don't get immediately, but the equity you kind of get when the house is paid off. Okay. So it's a little bit hard to calculate this, but I'm just going to do cowboy math, and we'll say that within a 10-year period, we got, let's say 350, 50 plus 443. So that's about 800K. Okay. And then we multiply that by 4. And we got $3.1 million of wealth within a 10 year period with only just four houses. Okay? With only just four houses. 10-year period. $3 million. So you might be asking, like, oh my goodness, what? And I'll tell you why most of you won't do this, okay? Because you're afraid. That's really why most of you won't do it. And the reason that I'm able to do it is because I paid, therefore I paid attention. That's really it, right? You know where I learned like all about this velocity banking stuff from? Renatus. I actually paid 20 grand. I paid, therefore I paid attention. Most of you, you might do it. I'm not saying you won't, but the reason that I just studied this hardcore is because I paid, therefore I pay attention. So if I say, hey, if you can make 20 grand and somehow make it into 3 million with just four houses, why wouldn't I do it? Right? I paid, therefore I paid attention. All right, so now let's go back here. Okay, let's go back to the next, the other spreadsheet, and I'm going to go to the Velocity Banking Landlord Reality. So now we'll just say this is paid off, and we didn't even do our mortgage, right? We didn't do our mortgage. So let's just assume like one rental property that's paid off, and holy, like paid off mortgage. I don't even know how. That's like oodles and oodles of cash flow. And this is where we have the rich people problems because now we just like I just got money in my savings account, like feeling like Uncle Scrooge where we're like swimming in the gold coins. And it's like, what do we do now? And now we got rich people problems for like everything's too good. Now what do we do? Right? Just buy a house every 1 or 2 years and just add more cash flow and then just go on vacation. That's rich people problems. All right. So now, um, I'll just say this: 4 houses, 3.1 million. Right? And you might say, is this really possible? I don't know. You tell me. Bought the home in 2022. It's not even 2 years now. It's almost going to be 2 years. I paid off my own personal home first this year, earlier this year. I just got to focus on this one. I should have paid it off in no time. I'm at literally like a 50% equity position. Most rental property owners will never get there. Remember how it took 5 years to get $10,000 shaved off the loan? Yeah, we're not going to be there, right? And we want to find happy tenants who are going to pay. Here's another secret to getting rich that most people don't talk about. Get paid by rich people, right? Get paid by rich people. I know it sounds crazy, but so many people don't want to listen to that. And it's like, well, yikes, right? We got to do things in a certain order. Just like when we pay off debt, it's in a certain order. When we make wealth and we want to serve the poor, we get paid by rich people first and then we serve the poor, not the other way around, right? Hopefully that makes sense. Okay, well, that's it for today. So you can see here that got pretty wealthy pretty easily in our simulation. I'm not saying that this is typical or even possible, but I practice what I preach and I'm doing it. But it's probably not possible for you. Probably. But again, because I paid attention, right? And I paid off my mortgage into 3 years. Okay. So, all right. Well, that's it for today. Okay. Well, have a great day, everybody. And we will speak next time. Goodbye. This is Korean Atlanta Mentorship.